this video, I want to talk about capital allowances. Now, I've mentioned it a few times in the past, but only really briefly and in passing. Today, I want to put the spotlight on capital allowances. Look, as landlords, we want to save money anytime, don't we? But right now in 2023, I know that we're hurting. I know that our profits have been absolutely shot to bits. So if there's any opportunity to save some money, keep more of that rent that you're earning in your pocket, then you want to know about it. So if you don't really know about capital allowances, well, this is an important section for you. I really want you to write down some of the comments that I'm going to be making in this next piece. Now, what is it? It's a tax relief on eligible plant and machinery. Now, hold on here. I know you're going to say, what on earth? Plant and machinery? It's not commercial. It's not industrial. Bear with me. The aim is that it lowers your profits. It artificially lowers your profits from your land and property, and therefore will lower your tax bill. Now, the context is that I'm talking to you if you either are thinking of buying a serviced accommodation or a holiday let property, or here's the thing, what if you already own a normal buy-to-let, I'm going to call it, a long-term family-let property, but there's a possibility that it might lend itself to being a serviced accommodation holder? Is it in the right part of town, or the right part of the country, that it might actually be repurposed as an SA or a HL property? Because this is yet another reason why you should consider doing that. Now, what is eligible plant and machinery when we're talking about a serviced accommodation or a holiday let type property? Well, here's a few examples. The HMRC says that this could be sinks, taps, showers, bathroom, lino, that's a 1980s word, isn't it? Floor coverings, carpets, door furniture, plumbing, wiring, all the electricals, the pipe work in the property that's already there, not stuff you're going to buy in the future. It's already there as you're buying the property. Then that can be converted into an allowance and therefore used to reduce your profit, reduce your tax bill. What's the process? Well, you can't just come up with it. It's not your accountant's job. They're not allowed to come up with a figure. You have to engage with a specialist type of surveyor. And they come along to that property and they do that assessment and they calculate what the plant and machinery is, convert that into a figure, that goes into a report, and therefore you can, when HMRC come calling, wave this report to them and say, this is how I came up with the allowance that I can then reduce the tax bill. Now, here's not just a case study, not just an example. This is one of my properties that I did exactly this with. And I want to talk you through it right now. So I purchased a 3-bed cottage. Now, originally, I bought it as a buy-to-let. I didn't buy it as a holiday let or service accommodation. I had long-term tenants in it on the normal 6 months process. And then over time, I decided to repurpose it as a small holiday. I mean, there's some workers in there, there's some tourists in there. It's a bit mixture of both. But essentially, going to use it as holiday let. Now here's the thing. When you are thinking of buying a property to use for this purpose, the capital allowance can only ever be claimed once. So if the previous owners have ever claimed this capital allowance on the items that I described a little earlier, you cannot claim it when you become the new owner. It's linked to the property, not the owner. So it can only ever be claimed once. So it's really, really important you get some confirmation whether the previous owners ever claimed that capital allowance. Now, in my context, this had only ever been used as a family home. It had never, ever been used by an investor or used by a landlord for any sort of rental purposes. So we got confirmation of that, and therefore we knew that we could claim the capital allowance on it for the very first time. Now, I bought this for 158k. The surveyor came along, did their work, converted it into a number, and their number, the allowance, was £38,886, which was roughly 25% of the purchase price. Now, my average profit as a holiday let, this is profit, not turnover, is about £12,000 a year. Now, it's held within a limited company, so I will be paying corporation tax of currently 19% on that 12k. However, now I've got this report with a figure of 38,886 in it. I've got over 3 years of profits I can make tax-free. Because every time I make £12,000 of profit, I take £12,000 off the 38,886, and the 12,000 profit reduces to nil, no tax pay. And now I don't have 38,886 left. I've got 26,886 available for the next year. I deduct another 12k off, that drops to 14,886, and so on and so on. So come year 4, I would have what, 12, 24, 36, £2,886 allowance left to offset against my profits right into year 4. So I've got all these profits that I can now keep every single penny on. And if we turn that into real pound notes, at 19%, that would save me £7,388. Anybody want £7,388? Yep, absolutely. So it's exactly what I did, and that's exactly what I'm doing, and that's why I want to share that potential good news with you guys. So, one final comment. This is tax advice. Although I am a chartered accountant, I'm not a practicing accountant. I cannot give you advice. So this should not be treated as tax advice. You need to make your own inquiries. Speak to your own accountant about this. Oh, and by the way, I know quite a number of clients have come back and said their accountant has never heard of this allowance before and may even want to dismiss it. Now, I'm absolutely telling you that this is a HMRC acceptable allowance in the right context. It might be that you're with an accountant that is not a specialist within the property tax arena. Just want to plant that seed. Are you with the right accountant if they're coming back and saying, I don't know about this, or they've never tapped you on the shoulder and said, you know, you can claim this if you already own a holiday let or a service accommodation property? Then have you got the right professionals surrounding you and advising you? That's a bit of an aside, but I think it's important to say. So if you want to know more about this, I have an information leaflet on it. So underneath this video in the comments, I'm going to put a link in there. So just click on it and download the information leaflet. It'll give you some more information. Hopefully it's going to have some real value. Hopefully there's going to be that pot of money that you can save, whether it's on your existing portfolio that you already have as holiday lets and SAs, or as I said, have a think about your portfolio and whether is this the extra element that's going to make it viable to move away from being long-term lets to short-term letting, because this extra allowance actually makes it financially viable for you to do so. So I'm hoping that's been of use to you. As I say, click the link and download the information, and I really hope that's of use to you.